Hey there, YouTube family. Welcome to the Stocks with Josh show. I wanted to jump on. Happy Sunday to you guys. I wanted to cover some of the things that are going on in the market. A lot of stuff is developing this weekend that's going to push into what happens Monday, and I want you guys to be prepared. We obviously saw a big crash on Friday, all tied up with Silicon Valley Bank and what was going on there. I've delved into it a little bit. I think I understand it. I'm going to break it down for you guys. I'm going to cover a little bit of some commentary that I've seen on what happened and what different technical traders are saying might happen for Monday. I've looked at the charts and I'm going to share all that and give you guys a little bit of perspective, my perspective on what I think is going to happen this coming week. We knew that last week was going to be a critical week, that 3940, 3950 on the S&P 500 as measured by the SPX. We didn't hold it. We didn't hold it for a specific reason. It was obviously that we're getting financial troubles in the banking industry. Now, before I even delve into what happened with SVB, I'm going to ask this question. It's going to be our overarching question for this video. Is this a micro event or is this a macro event? If it is a macro event, then it's going to indicate that we're going to get more of the same moving forward, and we need to get risk off and be protective of our assets if it's a macro event, news event. Okay, macro being big picture economy. Does this represent what's going to happen repeatedly all over the place with different banks and different countries? Or is this a micro event? Is this an individual isolated event that's having a big impact on the economy, but the economy can essentially shake it off and move forward because it's not representative of all of the other banking institutions? That's what we want to kind of think about and take into consideration in this video. So what exactly happened to Silicon Valley Bank? These guys, just like every other bank, they don't have your money. I did a video and I played a little clip of a famous rapper that went into a bank. I did it about 6 months ago. He went in, he said, guys, I need 100,000. I need to pull it out. And it was an interesting video to me because of how the bank handled him, how they spoke to him, what they said about his money. People push back sometimes. And someone said, come on, Josh, you can't expect banks to have your money. Well, that's a good question. How much money should the bank have? If they've got millions and millions of dollars of depositors' cash, how much should they have at the local branch? How much do you expect to be able to get out? If you had $10 million at a local bank, would you expect them to be able to hold at least? If you had $10 million, would you expect them to keep $100,000 of your money on hand so you could come and get it? Do you expect 10,000? Do you expect 1,000? Do you expect $10? Where is it? My concern is that I had begun to see and hear from a lot of different people, a lot of wealthy people, that it was actually not a very quick process to get cash. And sometimes they had to run through a little bit of a hurdle. They had to jump hurdles to say, come on, man, I'm going to need this cash. I'd like to get it on this day. And there's a lot of back and forth, and it wasn't as easy. It didn't seem as if these banks were responding with, absolutely, sir, we'll get that right to you. Give us 24 hours and we'll have it prepared in bands of $100 bills for you tomorrow at such and such branch. It just hasn't been that easy. And a lot of people have run into it. There's a lot of videos out there talking about the fact that the banks, just don't seem positioned to really provide the cash flow that makes them feel comfortable. That's what that video was about. So we're in a little bit of an environment, right? I've been predicting to you guys, talking about volatility. VIX measures volatility. Volatility measures fear, right? There's that correlation. And we see that even though the VIX had been down below 20, which really means the market's not scared, but the fact that there became this run on the bank indicates that even though the VIX wasn't spiked up to 28 or 30, it got there on Friday. But even though it wasn't there at the moment, the fear that people were feeling regarding their cash position and their investments was at a 30. The market didn't reflect it yet. But then when this news came out about Silicon Valley Bank, then the market caught up with the way people were feeling. So how exactly did this run on the bank happen? Well, you know that this company lends out billions and billions and billions of dollars, and they also borrow large sums of money. There's all that intertwining investing between them and other financial organizations. Every bank's required to have a portfolio of assets. It can be a percentage of real estate. It has to be a percentage of cash. It has to be a percentage of bonds or stocks or various things that represent the backing of all the money that has been entrusted to them. So they've got to keep a certain percentage. In the case of Silicon Valley Bank or SVB, these guys had a bond portfolio that was worth around $21 billion. And that was their primary foundation, financial cash position. It's not cash, but their financial position that they could turn around and liquidate so that if they needed to cover cash flow issues, they could. And what had happened is as the Fed begins to raise interest rates, it has a direct negative correlation to the value of bonds. This is something that I've been talking to you about on this channel. The bond markets have been going down because the interest rates have been going up. And so the problem, the opportunity that it gives to you and I is that when the Fed stops raising rates, which he hasn't done yet, but at the point in which he stops raising rates, that may be a great opportunity to invest in some bonds, some bond ETFs, because they've all been pushed down, right? And they're going to continue to go down while the Fed is still raising rates. That's what happened to SVB. They had a massive portfolio, bond portfolio, which was backing a lot of their financial decisions, and it had just shrunk in value. And then they got themselves in a position where they needed to raise capital. And so they attempted to sell their bond portfolio at a discount. In their minds, this was a massive opportunity to show their all of their investors and all the people that were invested in them that they were being financially fiscal, responsible, wise, good managers. And they set about doing this, not thinking that it would lead to what it led to. Simultaneously, we're going to sell that. Then they decided that they were also going to do some dilution with the stock share. They were going to raise about $2.8 billion by selling more of their shares. These two things in combination were not received by the market as smart financial decisions, but they were received like someone shouting fire in a movie theater in the dark. People took the news events, the news releases, the press releases, and began to panic. And then the CEO jumped on a Zoom call with some of their top backers, and he attempted to calm everybody's nerves and tell them that everything is okay. We're totally in control. Situation has not gotten, beyond us. And the opposite happened. Those investors got off that phone call being utterly convinced that they did not have control. And so they just started reacting with more fear. Now, this is one of the amazing things I want to just briefly pause and talk to you guys about. It's why I love Wall Street and investing in Wall Street. And I don't want to use the word addicted, but I got to tell you that I'll maybe use the word obsessed with researching, knowledge, learning, and getting into this game, because there's always an opportunity, always to make a big bag of money on Wall Street. There's only so many things you can do with your life that you can translate what you do into cash. Michael Jordan is one of the best basketball players of all time. He was able to translate that enormous gift and skill into large sums of money, deals with Nike. He was able to turn his skill into cash. And not all of us are going to be able to dunk like Mike. Not all of us are going to be able to do certain things that people can do. Tiger Woods, best golfer in the world, he had himself multi-$100 million contracts leading multi-years out because of his skill in golf. You're not going to be the best basketball player, not going to be the best golfer, but I love the idea of investing in Wall Street because you can research, you can study to show yourself approved, and you can learn to access incredible money-making opportunities. That's what happened actually with SVB. If you had known that they were in this position and you had jumped on and you bought a put, $100 put, before this run on the bank, the puts values, in the money put values, one of them went up 1 million percent. 1 million percent, which meant a $100 put option would have been worth, within a 24-hour day, a 24-hour window, close to $1 million. It actually would have been worth $900,000. And listen, there is nothing that I'm aware of other than Wall Street that you can learn, that you can research, that gives you the ability to touch that opportunity. Now, I didn't know anything about this particular situation. I'm only looking at it from the aftermath. But being quick, being informed, being knowledgeable of the market allows you to seize opportunities and make extraordinary gains. So their bond portfolio shrunk in value because of what the Fed is doing. They then attempted to reorganize, and that reorganization looked like bankruptcy to some people, and people panicked, snatched their money out of the organization, causing a run on the bank, causing their stock to fall 80%. Now, Janet Yellen came out. There's a lot of news that's going to hit throughout this weekend, leading us into Monday. And she said in a news report that the United States government was not going to come to the aid of these banks and bail them out to keep them alive. Okay, so she said, we're not concerned about these banks. We're not going to keep them alive. We're not going to keep their hearts pumping by infusing taxpayer money into them. Personally, I'm okay with that. But she said we are concerned about the impact that it has on the investor community, and we're going to look at working with them to keep them whole and to remedy that beyond the $250,000 guarantee that we all enjoy anywhere where we keep our money. Obviously, people had millions of dollars invested. And so she suggested that they were going to go in and look at those individuals and that they were going to help them get through the crisis. Personally, that I'm going to say is, before I give my opinion as to how I feel about that, I'm just going to say that this can calm the market. Her coming out and making those remarks could calm the market, and it would not be crazy for us to go into Monday and see the market to then just turn around and say, okay, now that we know that we've got the government's willingness to intervene, and what they want to see is spend. As long as we know the government will spend our way out of this and protect us and prop up organizations. They're not propping up the organization, but they're willing to prop up the investors. But that might translate into something the market wants to see, which is protection, the government safety net, the government spending safety net. Now, I just have to briefly comment and give my opinion that you notice how they had no concern to do that for FTX investors. All the crypto investors were on their own. Good luck, sorry, too sad, too bad for you. But, you get out there to Silicon Valley, and Janet Yellen's got a heart of compassion. She's ready to step in and keep some of these millionaires over there, these old West Coast millionaires, whole. Well, that's fine. The point I'm making, not whether that's right or wrong. I personally would have liked to have seen the government protect investors on FTX. They did not protect them when they were putting the money in, and they knew there could be a problem. And then when they lost the money, they didn't do anything to protect them. But Janet Yellen has said, we're going to help out in this situation for the investors. What that can do for you and I, even though it does nothing for us because I wasn't invested in this bank. I'm not old money, West Coast old money, Silicon money. I'm not over there, so it's not going to do anything for me. But what it might do is it might calm the market. And it might turn what some people argue is a macro event, a financial collapse event, into a micro event, which could be reversed by a micro news story like Janet Yellen saying will provide a safety net. So this is the other thing I wanted to share with you guys. I'm jumping around a little bit, but one of the investors that I follow, Mark Mineravelli, I follow him on Twitter. I've talked about him on this page again. Let me read a tweet from him. So Mark said this. He said, last week, our risk model went on sell alert, and yesterday it moved to an outright sell signal. So here's what Mark's saying. Now, if you don't know who Mark is, he is a winning annual day trading expert. So he's competed on a national level of day traders, and he has repeatedly won or come in at a very high level, maybe number 2, number 3. This guy is an incredible day trader, swing trader, and investor. And in my mind, he's beat Wall Street. He's proven that he can just draw that cash out of the system. It's an amazing, he's turned his knowledge into an ATM, into a debit card. He just goes in, to the Wall Street and pulls money out. And so he has his own technicals and his own way of watching the market. And he said that basically last week that the technicals were telling them that the market was getting ready to sell off, and it was saying be on sell alert. And then on Friday, it gave a sell signal. Okay, so basically at this point, the market is giving a sell signal. But he goes on to say, reversing our January 13th buy signal. So these guys had on Twitter notified everybody January 13th it was time to buy, which was if you had been buying January 13th, you would have enjoyed that phenomenal run up that we saw all the way through the end of the month. He's now saying that they have clocked a sell signal. But he goes on to say the market is oversold and may bounce. So here's what we're looking ahead. He goes on after that to say, but for the time being, we are recommending maximum caution. So I'm going to interpret that for you guys from my point of view. What he's saying is this. We're in a period of time, I talked about this in my last video, where we're going to be watching what the markets do. They obviously gave a sell signal, but the markets could have oversold and be in a situation where we get a dead cat bounce. So if you go into your trades selling everything Monday morning and we do get a dead cat bounce and then some more positive news stories come out and we see a recovery and that event went from being considered a macro event to a micro event, well, then you're trading against the markets. So what he's saying is this absolutely could bounce from here, but the overall market reached a peak and has now told us that it's sell time. It's you take profit was in the past, now it's get out. But be cautious, wait for a bounce, be aware that you could get a bounce, so don't just run in and sell everything. Once we get that bounce, if we get it, at that point, we have to determine it could be some additional news stories that could come flooding in right after we get that bounce, which could take us back into a positive technical territory, which might open up a new door for going higher. So I'm not arguing that the markets are going higher. I'm not arguing that the markets are going lower. I'm saying that we should be risk off and risk concerned, and you should go in and place stop losses on anything that you don't have stop losses on, because this very well could be the tide that pulls everybody down moving forward. But we're going to give the markets Monday and Tuesday to respond. I shared this with you guys. People who haven't been with me for a long time may not remember, but many months back when we first came up against what I called the Great Barrier Wall of 2022, and we hadn't broken it, we attempted to break through it, right? Only then for it to break below. Now, a lot of traders at that time interpreted that as a sell signal, and they sold everything, and we vacillated below only to skyrocket back above and to continue all the way from, at that point, the 4,000 range all the way up to the 4,200 range on the S&P 500 SPX. Now, we want to be cautious that we don't overact or overreact to the market right now, that we give it a moment, give it Monday, I said in my last video, give it 24 hours. Mark Mineravelli says it favors to the downside, but be careful. We could easily get a powerful bounce, a dead cat bounce perhaps. It has to be determined on Monday or Tuesday. That's what we have to watch out for and possibly trade. All right, guys, that's all I've got for you guys today. Thank you again for hitting the like, subscribe, and hit all notifications on the YouTube bell to get these daily stock and crypto insights. I'm going to be touching on crypto for a number of days moving forward as much as I can, because I'm personally focused on crypto. I'm making big crypto moves, big crypto decisions, and I'm just going to recap. This is a long video. I apologize. I'm going to recap what I said yesterday. When I wanted to buy at these prices, the market's given me these prices, and so I've got to decide whether I'm going to stick to my game plan. I am buying at these prices. That's it for today. I will see you guys tomorrow. Have a wonderful Sunday afternoon. As always, peace and blessings, my friends. Take care.